Before we jump in, I do earn a referral fee when you use the services and companies I demonstrate in the video, but there is no additional cost to you. I chose them because they're the best in the industry and you're safe with them.
Is a C corporation the right choice for your small business? We're diving into this question today, unraveling the intricacies of C corporations and their potential benefits for small businesses. A C corporation, in simple terms, is a legal entity separate from its owners, providing them with limited liability protection. As a small business owner, you may wonder why to consider a C corporation as your business structure. Well, it's not just about liability protection. The answer lies in the unique advantages that it offers, which we will explore in this video. We'll guide you through the process of forming a C corporation and discuss how it can potentially maximize your tax savings. So, whether you're already running a small business or planning to start one, understanding C corporations can be a game changer. Stay tuned to find out if a C corporation is the right fit for your business. So, what exactly is a C corporation? Well, in the simplest terms, a C corporation, also known as a C Corp, is a legal entity that is separate from its owners. This means that the corporation itself, not the owners, is held legally liable for the actions and debts the business incurs. Now, you may be wondering, how does a C Corp differ from other types of businesses? Let's break it down. In a sole proprietorship or a partnership, the business and the owner are legally the same entity. This means that the owner's personal assets could be at risk if the business incurs debt or faces a lawsuit. On the other hand, a C Corp provides a shield, often referred to as the corporate veil, that protects the owner's personal assets from such scenarios. Next, let's consider the S Corporation. While both C and S corporations provide liability protection, they differ greatly when it comes to taxation. A C Corp is subject to what's known as double taxation. This means the corporation's profits are taxed once at the corporate level and again at the individual level when dividends are distributed to shareholders. An S Corp, however, avoids this double taxation as profits and losses pass directly to the shareholders' personal tax returns. So, why would anyone choose a C Corp with this double taxation? The answer lies in potential benefits. A C Corp allows for an unlimited number of shareholders, making it an excellent choice for businesses that plan to expand or go public. Additionally, C Corp can retain and accumulate earnings from year to year, which can be a strategic advantage for businesses looking to reinvest in growth. However, these benefits come with potential drawbacks. C Corp are more complex to set up and manage, require meticulous record-keeping, and, as mentioned earlier, are subject to double taxation. Now that we understand what a C corporation is, let's delve into how to form one. Forming a C corporation may seem daunting, but it can be broken down into manageable steps. Let's embark on this journey together, shall we? The first step is filing the Articles of Incorporation. Think of this as your company's birth certificate. It outlines the fundamental characteristics of your corporation, such as its name, purpose, and the number of shares it's authorized to issue. This document is then filed with the Secretary of State in the state where you wish to incorporate. Next, we move on to creating the corporate bylaws. Bylaws are the rules that govern your corporation. They outline the structure of your corporation and establish the rights and responsibilities of directors, officers, and shareholders. They're like the Constitution for your corporation, providing a framework for its operation and management. The third step is appointing directors. A board of directors is a group of people elected by the shareholders to oversee the management of the corporation. They make the big decisions and steer the direction of your corporation. It's important to choose individuals who bring a wealth of experience and a diversity of perspectives to the table. Finally, we come to issuing stock. Stock represents ownership in the corporation. When you issue stock, you're essentially selling pieces of your corporation to raise capital. The number of shares you can issue is determined by your Articles of Incorporation. It's important to remember that once you issue stock, you have a legal obligation to act in the best interests of your shareholders. And there you have it. 4 key steps to forming a C corporation: filing the Articles of Incorporation, creating bylaws, appointing directors, and issuing stock. It's a bit like building a house. You start with a blueprint, your articles, build the structure, your bylaws, fill it with the right people, your directors, and then sell parts of it to finance future growth, issuing stock. With these steps, you're well on your way to forming a C corporation. But how does this move benefit your small business? Choosing to form a C corporation can offer several benefits for your small business. As we delve into the advantages, it's important to remember that every business is unique, and what works for one may not work for another. Firstly, C corporations offer limited liability protection. This means that business owners are typically not personally responsible for business debts and liabilities. In other words, if something goes wrong, your personal assets, your home, your car, your savings, are protected. This is a significant advantage that can offer peace of mind in a world of uncertainty. Next, there's the benefit of having unlimited shareholders. This is a big deal. Why? Because it allows for growth. With a C corporation, you can have as many shareholders as you want, and they can be from anywhere in the world. This opens up a world of possibilities for attracting investment and expanding your business. But it's not all about protection and growth. C corporations also have potential tax advantages. Unlike other business structures, C corporations are separate tax entities. This means they pay corporate tax on profits, and shareholders also pay tax on dividends. While this can lead to double taxation, it can also lead to tax savings in certain situations. For instance, C corporations can retain earnings for future growth, which can significantly reduce the overall tax burden. There's also the option to offer employee benefits that can be fully deductible at the corporate level. This can make your business more attractive to potential employees and help you secure top talent. So, there you have it. Limited liability, unlimited shareholders, potential tax advantages, and attractive employee benefits package. These benefits can make a C corporation an attractive option for small businesses. But how does it help with tax savings? One of the major advantages of a C corporation is the potential for tax savings. Now, this might sound a bit perplexing, but allow me to demystify it for you. C corporations are unique in the business world due to their double taxation structure. What that means is they pay taxes on their corporate profits, and then shareholders also pay taxes on dividends received. This might sound like a disadvantage, but it's actually where the potential for tax savings comes in. Corporate tax rates are often lower than individual tax rates. So, if a C corporation retains its profits instead of distributing them as dividends, the corporation is taxed at the lower corporate rate. This can lead to significant tax savings, especially for profitable small businesses. Now let's talk about strategies to reduce tax liability. One strategy is income splitting. This involves the corporation paying the owner a reasonable salary and then retaining the rest of the income at the corporate level. This can potentially lower the overall tax burden, as the retained income is taxed at the corporate rate, which is often lower. Another strategy involves fringe benefits. A C corporation can deduct the cost of benefits provided to employees, such as health insurance, retirement plans, and even certain types of life insurance. These deductions can lead to substantial tax savings. C corporations can also carry forward losses to offset future profits. This means that if the corporation has a bad year, it can use that loss to reduce taxes in future profitable years. This can be a significant advantage for businesses with fluctuating incomes. Lastly, C corporations can deduct the cost of state and local taxes, which is something other business structures can't do. This can lead to even more tax savings, especially for businesses located in high-tax states. By understanding and leveraging these tax advantages, a C corporation can be a powerful tool for maximizing your small business's profits. So, while the world of corporate taxation may seem daunting, with the right knowledge and strategies, it can be navigated to your advantage. Let's quickly recap what we've learned about C corporations. We started with an introduction to C corporations, understanding how they function and the process of forming one. We then delved into the benefits of a C corporation for small businesses, highlighting the unique advantages it offers. One of the key takeaways is the potential for tax savings. A C corporation's unique tax structure can be leveraged to reduce tax liability and offset income, making it a viable option for tax strategy. However, it's important to remember that these benefits depend on various factors, such as the nature and scale of your business and your long-term goals. As we conclude, it's crucial to keep in mind that the right business structure isn't a one-size-fits-all solution. It's a strategic decision that should be made in consultation with a business advisor or attorney. Remember, the right business structure depends on your specific circumstances and goals. Consult with a business advisor or attorney to determine if a C corporation is the best choice for your small business.